Short exercise 17-9, we're going to be measuring profitability. So Aisel's Companies, the home improvement store chain, reported the following summarized figures. So again, we've got income statements for 2 years, and we've got balance sheets for 2 years, plus some information about common stock outstanding. So our first task is to calculate the profit margin. Begin by selecting the formula for the profit margin ratio, then enter the amounts and calculate the profit margin. Round your answer to 0.1%. So the formula for profit percentage is net income divided by net sales. So what we're trying to figure out is, for every dollar of the thing on the bottom, in other words, for every dollar of sales, how much net income do we have? So if we got a result of 25%, that means we have 25 cents of net income for every dollar of sales. So now it's just a matter of finding net income and net sales. Net income, and we're doing this for 2024. So net income is 7,300. Net sales 40,600. So we got 7,300 divided by 4,600 equals, and then convert that to a percentage. Multiply by 100, 17.98, so that gives, we have to round to 1 decimal, so that rounds to 18.0. Next, we're going to compute the rate of return on total assets. So this ratio is trying to figure out how successful we are in using our assets to earn a profit. So the formula is net income plus interest expense divided by average total assets. So let's talk about the two things on top. There are two groups that finance a company's assets: shareholders, and what do the shareholders get in return in theory? Net income. And the other people that finance the company are the creditors, such as the banks. And what type of return do they get? Well, they get paid the interest, so we're going to include interest expense. So the two things on top are the things that the what the people who finance the company get in return. So then we just need to find the numbers. Net income, 7,300. Interest expense, 600. Average total assets. So for average total assets, we're going to add 82,800 plus 54,200 divided by 2. So 82,800 plus 54,200 equals 137,000 divided by 2 gives us 68,500 average total assets. So then we're going to take 7,300 plus 600. 7,300 plus 600, oh duh, that's 7,900, divided by 68,500. 68,500 equals, and notice we're looking for a percent, and they want it rounded to 1 decimal, so times 100 equals 11.5%. Is that good or bad? Well, you have to compare that with the industry average. And also know that no one calls it rate of return on total assets. They just call it return on assets, also known as ROA. Next we want to calculate the asset turnover ratio. So the formula for asset turnover ratio is net sales divided by average total assets. So what this is measuring is how good are our assets generating the thing on top, sales. So it's measuring the amount of net sales generated for each average dollar of assets. So net sales is on the income statement, 40,600. Oops, I gotta check my answer first. And then average total assets, we already calculated, it's up here, 68,500. And again, the average total assets, we got that by taking the total assets of the last two most current years, adding them and divide by 2. So 40,600 divided by 68,500 equals 0.59. And they want it to 2 decimal places, so 0.59. So what does that mean? It means for every dollar of the thing on the bottom, so for every dollar of assets, they generate 59 cents of sales. And then we will finish this problem after the next video.